I know this is near the end of the conference, so I'm sure you all have seen uh, lots of presentations. So I'll try to be succinct and to the point with ours. So as mentioned, our projects are in the northwestern portion of British Columbia. We've got three projects. We acquired all of them from major mining companies. Our idea was not to try to do grassroots exploration, but try to get a hold of assets that already had either a lot of money spent on them or some type of resource there to begin with. This is a tough enough business. How do we mitigate risk? That was our idea, to try to manage that. The other component of our strategy was not to pay for assets up front, but rather option them and then make sure there was some sort of economic viability to them before we would buy them. The GJ project is a copper gold porphyry that we optioned from Teck. Teck and NGX had spent around $26 million on that project. The SNP project is a past producing high grade gold mine, pretty legendary mine. It produced an ounce per ton, and we optioned that from Barrick, and then we acquired it for zero. Basically, we just had to take over the environmental liability, which was $3 million. Our last project, which is now our flagship project, is SK Creek. SK we optioned from Barrick, a 3-year option. We have a year left on that option. We will definitely be exercising and purchasing this property, and you're going to see why as we get into the presentation. Got a pretty lean company, 4 other people on the board. I'll just briefly talk about each of them. Craig Perry is chairman. Craig was co-founder of NextGen, very successful uranium discovery. Prior to that, Craig worked as a geologist for Rio Tinto. Don Siemens is our chairman of the audit committee. He's an accountant, KPMG by training. Most recently, he was on the board of Arizona Mines and Atlantic Gold, 2 very successful sales. Borden Putnam is an investment analyst. He's worked for several multi-billion-dollar funds on the West Coast in the U.S. And lastly, Isaac Burstein is with Hochschild Mining. Hochschild has a position in our company, and he's their VP of corporate development. On the management side, my background, as mentioned, I worked in finance prior to jumping into the mining industry. I don't think I knew what I was really getting into. Our CFO is his background is Price Waterhouse accountant. Paul Getty's VP of exploration. His background is with Barkerville Mines. He was head of exploration there. Kelly Earl, who's here with me, is our VP of communications, also a geologist. And lastly, Justin Himmelwright is our VP of environment and sustainability. You don't usually see small companies with this type of role, but our view is it's such an extremely important aspect of developing any kind of project in Canada, or for that matter, anywhere in the world. One of the reasons we love the Golden Triangle is because of the improvements in infrastructure that have occurred. Like, this is an area in the far north. There's almost no population up here, and yet we have power lines. Between our SNP and SK Creek project, in the last 7 years, we have 3 new hydroelectric facilities that have been built. They recently sold for $2.5 billion. Like, imagine the luck to be in the middle of nowhere, and we're basically 7 kilometers from plugging into super cheap hydropower. Our SK Creek project, you can drive in and out all year long. Huge advantage for any kind of project to have that kind of infrastructure there. So let's talk about SK Creek. Legendary mine. And the reason is because when it was in operation, it was an underground mine that produced at a grade of 2.5 ounces per ton of production. Like, have you ever heard of an underground mine, or any mine, to produce with that kind of...
You have your cell phone?
Yeah.
Yeah.
Okay. With that kind of grade, like, it really incredible. So our idea for going after this was, when it operated, the price of gold was between $250 and $400, so much lower gold price when this mine was in operation. Second thing, they didn't have the infrastructure. This was powered by diesel and propane, so it was a high-cost mine in a low gold price environment. And then the last part of our strategy was to look at this instead of looking at it again as an underground mine, to look at this as an open pit mine. Because obviously you can use a much lower cutoff grade. And then the obvious question was how much gold would be left? Well, it turned out there was, in the resource we put out 6 months ago, 4 million ounces at 4.5 grams. So surprised us and definitely surprised Barrick as well. Here's the PEA that we just published on Thursday, so about a week ago. 300,000 ounces a year in a 9-year mine life, so substantial amount of production. Even more spectacular relative to the amount of production is the CapEx, only $233 million US to put this mine back into production. And again, we benefit from all that infrastructure. We don't have to build roads. We're very close to power lines. It's also not high up in the Alpine. It's at an elevation of about 1,000 meters. The after-tax return, as you can see, is 51%. So that means every year this project kicks off after-tax cash flow equivalent to about half of the CapEx. So it's $147 million a year in cash flow that comes off of this project. All-in sustainable cost, $757 US, and the after-tax NPV is $640 million. So very robust project economics. Just to give you a look at the sensitivities of this project to gold prices, you can see that at $1,200 gold, $1,200 US, we still have a 40% after-tax IRR and a payback of 1.6 years. And looking at the opposite side of the spectrum, at $1,500 gold, the IRR jumps up to 63% and payback is less than a year. So certainly have some nice upside leverage to gold and margin of safety on the downside. This is a long section, and it's a little bit difficult to tell, but the shaded gray area is the pit on the left side, and we have a small pit on the far right in an area we call the 22 zone. The average depth of this pit would be 180 meters. So this isn't a big, huge pit. It's a pretty manageable, shallow deposit. Right now we have sort of equal division between the indicated resource and the inferred resource on tons. They're both about 13.5 million tons in each category. But the grade on the indicated is 6.1 grams, while the grade on the inferred is 2.9 grams. And we believe that to be somewhat of a consequence of drill spacing. So the spacing on the indicated resource is 10 to 15 meters between drill holes, while on the inferred it's 50 to 70 meters. Our hope is that as we do the infill and move that inferred over to indicated, we'll see some bump in grade there. It's a VMS deposit. It's very continuous, very predictable, and that's part of our reasoning for believing that we'll see a bump in grade. This is a little video just to sort of give you a visual idea of a lot of the things I've been talking about. Northwest BC, super beautiful, beautiful area. If you want a fun thing to do in the summer, come for a site visit. You see our 3 projects relative to many of the other mining projects in this area. It's prolific for mining. The local First Nations are the Tahltan and the Nisga'a, both extremely supportive of mining. There's that power line going up to the Red Chris mine. There are the 3 new hydroelectric facilities between SK and SNP. Now we're going to zoom in. This is the tenure that we have. It's about, I think it's about 7,000 hectares, give or take. And again, as I mentioned, we're not in the high alpine. We're sort of midway up. This is the kind of terrain grizzly bears love, which makes for a little bit of excitement for our geologists in the summertime. So this is a drone flying over the ridge, and the deposit is basically in this ridge right here on the left. You can see a drill rig right there. Now we'll show you what the pit looks like. That's the main pit. There's the historic area where they had the mill. The mill was dismantled and sold back in 2008. They shut the mine down during the world financial crisis, which always makes you go, oh, there's probably opportunity then. Two types of mineralization. There's a mudstone layer on the top that has higher grade, and then there's the rhyolite layer underneath. The other difference between the two is that the mudstone layer has a degree of impurities, while the rhyolite doesn't have any arsenic or mercury. About 70% of the deposit is in the rhyolite, and about 30% in the mudstone. Those gray areas are the historical workings. They were paste backfilled with cement and river rock, so they shouldn't be an issue for us when we do the open pit. There's a resource down on that bottom left that is an underground resource, and that's not included in our mine plan. Yep, and you can see the second little pit right there, all rhyolite. And we think there's exploration opportunity between those two pits to sort of fill that in, probably with rhyolite. Yeah. So again, that shows you the main pit and the waste dump. Now, one of the exciting things here is the deposition mechanism on the mineralization were feeder zones. So basically, this is a VMS deposit. There were vents on the bottom of the ocean floor, and as the hot fluids came up from the vents, hit the cold ocean water, they created that layer of mudstone. So that used to be the bottom of the ocean floor. Then you had a late stage like lava flow that covered it up. But we think there's excellent exploration opportunity following those feeders to depth. So that's what you see in these sort of highlighted areas, is we think there's good exploration opportunity there in the feeder zones. The other pretty interesting recent drill result that we put out was this 300 grams over 2 meters, and that's at a mudstone layer that's about 20 million years earlier. So that hit right there used to be the ocean floor 220 million years ago. And then the main area that was mined before, that SK contact mudstone, which is right in here, that was the ocean floor 20 million years later. So that's where they historically targeted, was that area. So what's left is they didn't touch the rhyolite, which is right here and here, and they left remnants of the mudstone. So that's what we're going after. But our idea down here is to fill in drill holes, especially where it comes up towards surface. And this is a potential, it's not included in our PEA at all, and it's potential upside to our PEA. So we'll come in here and drill this area and see if we can create some continuity to this. Other recent drill holes that we have in here, 27 grams over 9.4 meters, 17 grams over 7.5 meters. So that's the infill that we're doing right now. But pretty spectacular intercepts. With 4 grams, this ranks very well globally in terms of being one of the highest open pit deposits in the world. You can see 4 grams, where it stacks up in North America and globally. I once had an engineer say to me, good grades make for good miners. And that's why we have such strong economics, is 4 grams per ton open pit. This is where we, looking at us from a valuation perspective, our market cap is $70 million right now. If you take our NPV and divide that into our market cap, we're right now at a 0.1 times NAV. And most development projects that are out there are trading at sort of a 5 to 6 times NAV. So we like to think that as we get out and sort of tell this story more, hopefully we can close that gap between a 0.1 times NAV and working our way up. You can see Silvercrest over here trading at 1 times NAV. So we think we've got a pretty strong project that can hopefully gravitate somewhere up this curve on valuation. Just to emphasize again, our CapEx, it should say 233 million right there. You can see that relative to the amount of ounces we produce, it's an excellent capital intensity ratio. We also think we'll be able to grow this number from right now 306,000 ounces a year. We think there's some opportunities to probably get this closer to 400,000 ounces a year. Now, there's a little bit of a give and take. The reason our CapEx is so low is because we're creating a concentrate. So we're not building out all the circuits to create doré at site. And what that means is we're sending the concentrate to smelters, and smelters take their pound of flesh. So while we have excellent capital intensity, we're in the second quartile on the OpEx side. All-in sustainable cost of 757 puts us right here, when you would almost think because of our grade we should be in first quartile, but that's the give and take. We're very proud to be a founding member of the BC Regional Mining Alliance. This is very unique because it's a collaboration between the First Nations, the government, and industry. So right now there are 4 companies in the Golden Triangle BC Mining Regional Alliance, along with the Nishka, the Tahltan, and the government of BC. The premier of the province gave us $1 million to support this effort, and basically it's a joint effort, all of us going around the world collectively with our First Nation partners and with the government to explain to people that British Columbia is definitely open for business as far as mining goes. We've got 115 million shares outstanding. Shares are trading right now at around 62 cents. So that's where we get to the $70 million value. Our only strategic is Hochschild Mining. I would imagine that over the next couple months we might take another strategic investment in. So with that, thank you very much for your attention and time.